All eyes on Friday's jobs report and what it means for the U.S. economy. I'm Lisa Bernhard with Reuters, and I'm joined today by Matt Stuckey. He's Chief Portfolio Manager, Equities at Northwestern Mutual Wealth Management. Matt, tomorrow we get the November non-farm payrolls report as the Fed looks to slow the economy, to bring inflation down. What in particular will you be looking for in tomorrow's report?
Yeah, tomorrow's employment report is certainly going to be a market mover. And within the report, we're going to be focused in on two specific items. First and foremost, the unemployment rate, which has actually been rising since April of this year from 3.4% all the way up to 3.9% or so. That's typically what you tend to see kind of on the precipice of actual monthly job losses. Now, we're not expecting that tomorrow. However, the longer that we see a rise in the unemployment rate, typically that means that job losses are around the corner. The other area that we're looking at is the wage part of the employment report. Wages are still too high for the Fed's comfort level, which means that they're likely to keep their own monetary policy in restrictive territory until they're comfortable with some loosening in labor market conditions that brings down the overall kind of wage environment, which would be more consistent with their inflation goals. And so those are the two areas that we're the most focused on. Without a doubt, it's likely to be a market moving event.
So stocks are up across the board today, a day before the jobs report. Why is that, do you think?
Stocks are putting up good returns throughout the day today. I think there's a few things going on. First and foremost, the leadership today is being driven by mega cap tech. And within that area of the market, there's a couple of strong product developments announced yesterday after the close. First from Google with their Gemini AI model, and also AMD's accelerator model. I think what was interesting and probably driving a lot of optimism today with the AMD update was just the upsizing that they gave in the overall accelerating compute market, which they've moved their TAM from 150 billion or so worth of the size of the market up to 400 billion. So that's a pretty big increase in the overall kind of addressable market for their chips. And so a lot of other players that operate in this space are getting a lift on some of that higher levels of optimism that we saw yesterday.
We had other company news this week from McDonald's, which announced that it's planning to open about 10,000 restaurants globally by 2027 in what could be the fast food giant's, fastest period of growth in history. It's also opening these 10 Cosmic, if I've pronounced that correctly, stores to compete with Starbucks. The stock is up 8% this year. The earnings have been good in these inflationary times. But it's lagging, the broader S&P, which was up 19%. I mean, why don't you think we're seeing a bigger stock movement with McDonald's this year?
That's a good question. I think it speaks to the broader kind of composition of what the market gains have been this year. There's a huge contrast between what the S&P 500 has done on a market cap weighted basis versus the S&P 500 on an equal weighted basis. An 8% return year to date for McDonald's is a solid return, but it is quite a bit underneath the overall market index, which is up close to 20% or so, if we want to call it that. Contrast that to the equal weighted index, that's up in the mid to upper single digits. And so McDonald's is competitive with kind of more of a less cap heavy index, which the S&P 500 has become, as some of the largest mega cap tech companies have rallied significantly this year, outpacing the overall index by quite a bit.
All right, I do want to circle back actually to the jobs report and talk about the Fed and, the Fed going forward. Historically, when we've seen these kinds of rate hiking cycles, and granted this was a dramatic one, has a recession come? What's happened to the economy in the aftermath?
Well, the Fed's track record in engineering soft landings after a hiking cycle isn't something that's all that impressive. In fact, just the opposite. It's something that should give us a little bit of caution as we think about markets. Unfortunately, we do think that the ramification of all this tightening policy, not only from the Fed, but from the financial institutions in our economy tightening up lending standards, are likely to lead to some form of a mild recession in 2024. In terms of positioning, what that means for us is that we are more favorable on high quality fixed income than we are traditional equities at this point. We've positioned our portfolios overweight high quality fixed income, where we see the potential for nice income generation, but also capital appreciation if the Federal Reserve is forced to reverse its tightening stance into an easing stance, which means interest rate cuts. Bonds rally when interest rates go down. But from our perspective, we see kind of nice income generation with the optionality for capital appreciation if we're correct with the recession call.